Hi guys, I hope you are well. Welcome to another lesson in this module as we look to progress ourselves further and further and further. Today I want to talk to you about something called auction market theory. And I was thinking when I wrote this all down, I was looking at potentially making this two lessons just to kind of shorten them up a little bit because I don't want to be going on and on and on for just kind of over an hour talking about this. But this is something you may feel like you understand completely when you get into the market, but if you are not yet profitable, if you are not yet passing funded accounts for fun, if you don't sit here and find everything completely simple to just compute, then it's always going to be worth understanding. And there might be stuff that you're actually missing in within here. So yes, in two ways. One way, I am going to strip back a little bit, but also we're going to kind of discover why. And the next few lessons are going to be really, really deep in terms of really getting into the markets and why we move into the markets, why we do what we do, why we look for what we look for and things like that. And we do just have to really understand this. Now, what we're looking at here, and this is from this website here, I found this on the internet, really useful page here, and basically it's got this whole cycle of auction market theory and how it obviously represents itself, and you can apply this to many things. Okay, so in terms of something that's fair value, in terms of balance, you've got supply, you've got demand, high volume and all that kind of thing. So you could buy a car, for example, at a high value, and then it could change the price. Someone will buy it at a lower price and up the value and that kind of thing. Now, when there is a market event, this could be news, this could be session opening volatility or something like that. It then creates other things such as imbalances. It creates demand, it creates supply, and vice versa. Now, just to confirm and reiterate to you guys, we are not supply and demand traders. So don't think that that's what we are, because we really are not supply and demand traders. We understand supply and demand, and we see certain things which a supply and demand trader might think is an entry, but we're not utilizing supply and demand in this example. Now, when you move over to where it says here discovery, we've got something called basically buyers and sellers in volume, and that is you and me and everyone else. Okay, to get into the market, you have to be a buyer or you have to be a seller. To open a position, you have to take someone else's position. To get out of a position, someone else has to take your position. Now, there are a lot of traders in the market, but the market is moved and formed around by opinions of the marketplace. The algorithm works in a certain way where it drives price in certain directions, which is obviously something we can't control. But you do get an injection of volatility in the term of sellers, and you get an injection of volatility in buyers. They are two different things. You are either buying or you are selling. There's no in between with it now. And it always cycles back to the whole point of it's looking for balanced price ranges. It's looking for fair values of the market to see if basically it can drive price and basically buy or sell it for a profit. Now, this goes on and on and on. It cycles all the way around, just like with consolidation, manipulation, expansions, retracements, reversals. It does that. It rinses and repeats. It rinses and repeats. But what you have to remember is the market is leaving you in front of your own eyes. It is leaving you with plenty of information to make informed decisions to decide whether you want to be a buyer or a seller, and that is whether you are trading like we do in smart money concepts or whether you are trading as a pattern trader, because even a pattern trader will wait for a certain pattern which is their signal to buy or sell. That doesn't mean that they're not making money because they don't trade the same way we trade. We trade the way we trade because we understand this is the way to do it. This isn't necessarily the right or wrong way to do it. Someone could have a strategy that is completely random and what you may see as completely false, but if they make money from the markets, it does not matter. And that's the most subjective thing in here. I hear a lot of people say there's a right and a wrong way to things, and yes and no is what I would say to that. In terms of the markets, if you can consistently withdraw profits from the markets, you are winning. And that is what we're all here for. That is why you've invested your time into this course. You want to understand how we are going to make money at the markets. And that's what I'm here and dedicated to show you how to do. So moving this into a chart, and I'm only going to look at a few time frames, but just understand they are all completely fractal. Okay, price is fractal, meaning that whatever you see here can happen on a 12-month time frame. It can happen on a 5-second time frame. It really does not matter. And this is what you have to kind of understand. Now, when you look at this explosive move higher, and then you see price coming lower again, what you can identify is that there is sellers in the market at this level here. Now, the reason there are sellers in the market at this level here is because someone has sold. Okay, so it doesn't matter who in this situation has decided to sell, but this person here is a seller in the market. It can be anyone. Okay, it can be anyone. You can name that person whatever you want to name that person. There is a seller in the market, and he is selling, or she is selling, down into wherever they want to sell to. Now, in terms of where we are looking to buy, or you're looking to buy, it is actually irrelevant in this situation. But what you have to understand is, where are you going to buy or sell at fair value in terms of price? Now, obviously, if you take this entire candle moving to the upside, you can see it's pretty big. Okay, that means that price has aggressively pushed on to the upside until it's obviously reached this level of resistance where price is now breaking lower. This is where this person here has decided they want to be a seller in the market. Now, I don't know why I keep pressing escape. What you end up getting is essentially people are now buying in and around this level here. So when that person there is buying, it's buying against the person who is in this position here. So one or two things are happening with these people up here. Now, there's a lot of people representing just this one person. There's a lot of people representing just this one person here. But when price comes down to here, this person is in profit. When this person here wants to buy and not sell, but buy, whatever their condition is, whatever their rules are, whatever their market analysis strategy is, they are buying price which is at better value than what it was if you would have bought it up here. And price is in a better buying position because it's been driven down by this person right here. So because now price is at a better fair value, it's now worth us buying price because it's naturally lower than where it originally was. And obviously you could argue you could be buying down here, but I'm not talking about down here. I'm talking about where price is currently in from where this person up here has sold. Now, let's say this person stayed in the market. This person's now entered the market and bought price. You can see that the value in price is getting better to the point where this person can sell price when it gets to this level here, as an example, or above this line here, which we know is a high that signifies liquidity. So when we come out of the market, someone else, as in this person here, again, wants to sell it. And they've got their own ideas that they want to sell price because you've decided now to come out of price. But you've got it for a better price when you sell it back to this person here, which can be the same person. This person's dedicated to sales. This person down here is completely dedicated to only buying in price. And this is the simplicity of it. These people here are looking to sell. These people here are looking to buy. Your job in the market is to do exactly what all of these people are doing. And you just have to understand when I come out, I'm selling this, but what am I selling it to? I'm selling it to this guy here, or this woman here, whoever it may be. I don't want to assume anyone's gender. And then obviously when this person originally sold it into this area here, they might be coming out maybe at this level here, or maybe at this level here. And they might be allowing you to buy price. So you're now buying price off the person here. So they've come out of profit. You're about to go in. You're going to come out of a profit for this person here. Now, let's say, for example, this person carried on selling price. We can now see price has cleared above these levels right here. As soon as we see that, what do we think is now starting to happen? Let's get out of this bit here. So now we can see this is starting to happen. What does this mean for this person here? It means they're trading at a loss. It means that they sold it here. It's worth more. So if they try and sell price, come out of their position, they're having to come out of it for a loss, which is why in the market we have protective stop losses. So this person might have a stop loss above here, and this person might have been taken out of the marketplace. Therefore, they have released their position, and then they have lost money essentially in the market, and they've lost the value in it. It's the same thing. When you buy a car, it loses its value. So how many people have here bought a car and said, okay, I'm going to promise to the person I'm selling it to, or I'm buying it from, sorry, that I'm only going to do 12,000 miles on it every year. In the UK, that's a rule they kind of try and get you to stick to, especially if you're not outright buying the car. You're essentially leasing the car until you can come out with a finance agreement. Now, at the end of that 3-year deal or 4-year deal or 5-year deal, let's say you've done over 12,000 miles every single year. Let's say you've really gone off the end of it and you've gone 20,000 miles every year. The car is going to be worth so much less. So you're actually going to be in a car that has no equity. And you're actually going to be faced in a difficult position because you're going to have an asset which is going to be worth virtually nothing. In fact, to get rid of it, you might have to be paying to have it back because it's lost that much value. And your car is so if you bought it for £10,000, now it's only worth £4,000. And then you're in a bit of a stickier situation, as where if you had the car and you looked after the car and you kept the mileage low, you can often keep the car as yours, or you can get rid of the car, sell the car. Okay, you're not going to get it for 10,000, but it might be worth 6,000 or something like that. So you're getting something back, if that makes sense. And then that's what this person's now trading at a loss. And then what's happening now? More people are buying in the market right here. So this person's in loads of profit because where he bought it from, it has gone up and up in value. Cars don't do this, which is what we've decided. We know now. Cars depreciate in value. But this here is going up in value, so we can sell here at a better price, and we've made money because we've bought here. We've sold our trade back to these sellers up here, and look at what's starting to happen now. The buyers are becoming exhausted. So the buyers are starting to die off because price is now entering a what? Price is entering a premium level. And now price is beginning to enter a premium level. Sellers are starting to come back into the market. Now, there could be a level down here somewhere which is giving someone confirmation. I'm not bothered about how or why this person's selling, but they've started deciding to sell off. And the value now is becoming back down and level to where these guys originally sold. So now they're making their money back. If they've held and they hadn't had stop losses, or their stop losses are up here, they're beginning to make their money back. Or maybe they want to have another go at selling up here. So if price is starting to sell up here, just as an example, then sellers are now in the market. Now, how can we buy at balanced fair value levels? Because we want to be selling when it's in a premium. We've gone over premium, we've gone over discount, we know what that is. And if you're unsure on premium discount levels, go back and watch the videos on premium levels, discount levels. And the rules on that never change. We're looking for areas or places that we can enter in the market now. And what we're going to be talking about in the next lesson and a half is looking for areas of inefficient price action. Because now look, there are only sellers in the market here. Now there's two things which are going on here. Why is this a very decent looking place to sell? Because let me just get rid of this for a second. Price was aggressive in its movement, moving higher, leaving this imbalance right here. When this imbalance was created, that there is called buy side imbalance. Okay, it's called buy side imbalance because there are only buyers in the market and it is inefficient price action to sellers. And why that is inefficient to sellers is because if that price action right there was without all of this price action here, it is inefficient to sellers because it's not balanced price action. And to have balanced price action, it needs to make lows, it needs to retrace, rebalance the leg that it created. It then needs to expand, it then needs to retrace for the purpose of rebalancing this level here before it goes on and expands again. You will never see price just shoot down like a falling star. It can't happen. There's too much exhaustion going on in here. It just isn't possible to happen. So price needs to rebalance. Where does it need to rebalance against? Levels of imbalance right there. Levels of imbalance right there. Why is that an inefficient level? Because before this level here, that was sell side imbalance because there were only sellers in the market. Inefficient to buy side buyers. So buy side have come back, rebalanced that price action, and then taken price lower. So where now we've got this sell side imbalance, the buyers are currently in drawdown. So the buyers are going to come back up, rebalance price action. It is exactly what it says on the tin. It's going to rebalance price action. It's going to take price to the downside. So now what we're left with is price rebalancing until you can see the rebalance here. What's happened? We have rebalanced to the point where we have actually violated this imbalance that's being created. Now, why is that significant? It's very significant because buyers have been violated. Sellers have overpowered this imbalance, which now means this is what's known as an inverse fair value gap. So it's not being respected. And what we need is for imbalances to be respected. So if this was going to stand as a respected buy side imbalance, sell side inefficiency, sellers would have come back into the market. These candles would not have closed below it. It would have closed within here. And then it would have carried on moving to the upside. That would be a respected imbalance. But because we have not respected the imbalance, it is now turned into an inverse imbalance. Whilst also doing that, we have created a new sell side imbalance. That sell side imbalance is also inefficient to buy side. So it is called sell side imbalance, buy side inefficiency. That is an area of inefficiency where buyers are coming back up. They're taking price. Look, they've gone all the way down here. They've rebalanced price action to the point where they've come back into here, and then they're moving in their intended direction. It's gone way away and above and past it. You can see here again, we've created a level of imbalance. It respected it. Price then drops. Well, actually closes here. But look at this candle here. Price purges higher, closing up to this level here. well, not closing, but it came up to this, pierced into this level of imbalance, sell side imbalance, back mitigating into this inverse area, because that is also an area of resistance coming back to an inverse area. It just gives you the added confluence if you've also got active sell side imbalance. But then look at the interesting thing here. Price has dumped to the downside now and still respected. There's no candle has closed inside this sell side imbalance. So price has respected both imbalances and ended up closing here. That, ladies and gentlemen, is the biggest ever hint in the entire world that price is in the mood for selling. There is no buying whatsoever coming in here. Buyers are in the market. This guy here is buying up here. And he or she, both of them, are selling now. So they're selling at the value. So the point in where I was talking about buyers and sellers in the market is true. What you need to be good at is knowing when to get into the marketplace to sell for a better value than when to buy. You can understand here that just based on the whole entire leg of this level right here, you are extremely bullish to the point where you are in your premium levels. So when you see that price has overextended itself way higher than it needs to be, at some point we are going to have to allow sellers back into the market, meaning you can be a seller at a really good level. Where can we find these levels now? We can find them at these inefficient areas. Once price has done this, once price has sold off again, bear in mind as well there's another area of imbalance which has turned into what? An inverse, because it's closed well below it. Now we've left this order block. Look at the order block that's been respected. Selling off to the downside. You can look at this and backtest this as much as you want. Look at these areas of inefficient price action. You could have been a seller in here, all the way down to here. And when you come out of this, someone else is buying your price, but you're coming out at a profit because you sold it up here and you're making money from it. Someone has bought inside of this buy side imbalance right here. And again, that could be you. You could buy in there. I think this is the imbalance we were looking at a few weeks ago to buy inside of. But price ends up respecting a bearish order block, which also respected sell side imbalance. Sell side imbalance. Sellers are in the market. Where is it going? Where is price moving towards? It's moving towards extreme levels of liquidity. And I've told you before, and I'll tell you again, the market will seek liquidity. But where we can look to get in is through areas of inefficient price action. Knowing that price has to rebalance, you have to get in at a fair value, and price has always going to have a buyer and a seller. It's your job to just try and work out how many times can I buy or can I sell and physically make money from it. Understanding as well that you don't have to make money every time. These sellers that had their stop losses here did not make money this time. They lost money. This person sold up here, was making a lot of money, as opposed to the buyer down here who is making money when he bought price or she bought price. Maybe that was the target, but let's say they wanted to hold to take out the target above, because that person up here is a seller, only to be caught with stop losses being hit. And what is another word for stop losses? It's liquidity. Because people are placing stop losses everywhere in the market, wherever you are. and it doesn't matter where you are, stop losses are getting hit. If you are a seller inside this imbalance right here, and you're holding price action down to these levels here, you are personally stopping out someone else. That's the harsh reality of it. You're stopping out these people. You're stopping out these people. There's stop losses everywhere because buyers are always in the market, sellers are always in the market. Why is there a huge selling pressure? Because there's not enough buyers in the market. Price comes up, rebalances, drops down. This area here, unmitigated. Price tests this level multiple times. What does it not do? It does not bring the body any higher than this. What is that an indication of? Selling pressure. This is not a buyer's candle. People are buying in here, but the algorithm is bringing price up to give people a better fair value to sell as opposed to just selling down here. So someone is buying to give you a better chance to sell for a better price. So I'm going to leave this lesson here and I'm going to dive into this in a little bit more detail in the next lesson. But hopefully you found this insightful, and as always guys, reach out if you have any questions. Thank you very much guys.